This split-screen chart illustrates a glaring disconnect in the public markets. On the left, Arch Capital Group's stock has effectively flatlined, trading in a tight channel between $90 and $95. On the right, the company's net income is surging 80% year over year, hitting $4.36 billion. The underlying financial strength is substantial. Arch generates over $6 billion a year in free cash flow, and they hold a cash reserve that exceeds their total outstanding debt. Wall Street sees this data and ignores it because the broader insurance market is softening. Cycle pricing has peaked, premium volumes across the industry are shrinking, and consensus analysts are applying a strict cyclical penalty to the entire sector. CEO Nicholas Papadopoulos, a 25-year veteran of the firm, makes no attempt to sugarcoat the situation. On public earnings calls, he admits that the market is deteriorating and explicitly tells analysts that he is intentionally allowing the company's revenue to contract. A CEO willingly shrinking his top line while printing billions in free cash flow creates a distinct mathematical setup. Understanding how Arch navigates this specific phase of the insurance cycle tells you how to identify a genuine capital compounder. Arch is domiciled in Bermuda, operating an underwriting engine designed to explicitly reject Wall Street's expectation of perpetual revenue growth. To evaluate an insurance company, you start with this gauge, the combined ratio. This metric tracks the percentage of premiums eaten by claims and expenses. Anything below 100% means the actual underwriting is profitable. Arch operates with an 80.8% combined ratio. Maintaining this level of discipline is the primary directive of the business, overriding any pressure to expand market share. This diagram breaks down the structure supporting that ratio. The risk is divided into three mathematically distinct pillars: reinsurance at 52%, direct insurance at 42%, and mortgage insurance at 6%. Reinsurance is highly volatile, and recent renewal pricing has dropped 10 to 20%. Rather than accept lower margins, Arch is purposefully refusing bad deals, allowing their net premiums written to fall by 6% in early 2026. That discipline extends to their direct insurance pillar. When they acquired Allianz MidCorp, they systematically walked away from the inherited subpar legacy programs rather than renew them at inadequate rates. Those volatile segments are anchored by the mortgage insurance division. Arch operates in a regulated six-player oligopoly here. Because millions of U.S. homeowners are locked into sub-4% mortgages from 2020, defaults are nearly non-existent. This segment runs at a staggering 20 to 35% combined ratio. These three segments do not correlate. When severe weather events hammer the reinsurance book, the mortgage division continues collecting premiums on static housing risk, protecting the company's total capital. During a soft market, the standard industry trap is to lower underwriting standards and write unprofitable policies just to keep revenue numbers stable for quarterly reports. This flowchart tracks two distinct choices. Path A maintains revenue but destroys the combined ratio. Path B is Arch's playbook. Let the premium volume shrink organically so the margin stays perfectly intact. Path B results in a significant capital surplus.
Arch generates $6.1 billion in free cash flow against a total market cap of $35 billion. Rather than hoarding that cash or forcing acquisitions, they funnel it into aggressive share repurchases, retiring 5.6% of their outstanding shares in a single year. This creates a permanent structural advantage. Over 7 years, their outstanding share count has contracted from 415 million down to 360 million. Because the stock currently trades on the Nasdaq at just 8 to 9 times trailing earnings, every dollar spent on these repurchases accelerates the growth of per-share value. Shrink the policy book, reject the bad pricing, cannibalize the outstanding shares. This exact mechanism allows Arch to manufacture a 15 to 20% compounding of book value per share, completely independent of the broader market conditions. This line graph reveals the primary anomaly in their current financials. In early 2026, reported operating income surged 53%, but actual operating cash flow dropped 18.5%. The mechanics behind this divergence are tied to how insurance accounting works. Arch is releasing reserves they set aside during highly conservative prior years. This directly boosts the reported paper income you see on the income statement. Simultaneously, the physical cash flow drops because they are actively writing checks right now to settle the actual claims from those older policy vintages. The explicit risk here is that prior year reserve releases can act as a convenient accounting cover. If current year underwriting quality is actually deteriorating and finite reserves are masking the damage, then reported profits become a dangerous lagging indicator. There are also structural headwinds. Bermuda recently implemented a 15% corporate income tax, which permanently resets Arch's after-tax baseline and removes their previous zero tax advantage. Finally, you cannot hedge against a Category 5 hurricane hitting Miami. Catastrophic climate events or sudden geopolitical shocks have the potential to wipe out a full year of underwriting profit in a matter of hours. While the leadership team has navigated these cycles for over 2 decades, any prolonged decoupling of cash flow over the next few quarters would be a clear sign that the compounding engine is breaking. Tight underwriting protects the income statement, but the balance sheet provides the structural endurance for a multi-year soft cycle. This scale shows the physical weight of the Arch balance sheet, $79.2 billion in assets against only $2.7 billion in debt. Inside those assets is a $47 billion investment portfolio. At current yields, it generates a structural income floor of over $2 billion annually. The base case for the next few years is conservative. Earnings per share normalize around $9. The share count continues dropping toward 340 million, and book value quietly crosses $80. It is a profoundly boring proposition. While the broader market chases speculative technology narratives, Arch demands the patience to sit sideways during an ugly phase of the insurance cycle. They shrink the book. They protect their margins. They buy back equity at deep trough multiples. When the pricing cycle inevitably hardens again, the investors who waited will own a significantly larger slice of a highly optimized machine.